we talk about this all the time. When your EBITDA growth is estimated to be higher than your revenue growth, your stock should be moving from bottom left to top right.
It used to be just, I saw Teslas everywhere. I've now seen a handful of Rivians on the road near where I live. I've just saw my first in-person real life Lucid Air driving around town. I've seen Hyundai Ioniqs around.
First of all, your price target on the stock is what, $733. That's essentially not far from where we're at right now.
So they need something new to get investors excited, at least institutional investors.
Well, look, if you were negative on the stock at 200, split adjusted, you're gonna continue to be negative, even though it's had thousands of a percentage point higher, because of what we've seen in terms of execution.
In this video, the mixed bag of reactions to Tesla's Q2 earnings continue. Wall Street stock analysts all over the shop, some bearish, some bullish, and some in between. So let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks. Check out the links in the pinned comment below. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. So check out the links in the pinned comment below, and thanks for your support.
Good to see you, Dan. I mean, it's amazing here. When I saw Tesla moving back above 800, when it was at 6 something early, it was at 620 back in May.
Just out of interest, let me know in the comments below if anyone watching was able to pick up Tesla stock in this $600 range just a few weeks ago. I mean, I'm laughing because I cannot believe that Tesla was available just a couple of weeks ago with a 6 in front of it. Full disclosure, I picked up 92 shares of Tesla stock in the $600 range, which is about what I was paying 15 months ago in early 2021. Unbelievable, but it happened.
People were doubting it, and look at it now. What do you think here?
I mean, the haters will always hate, when it comes to Tesla, and they've gone through some significant challenges. I mean, if you look at April and May, China's shutdown, I mean, that was an ugly quarter. But I think for Tesla investors, it was looking past that, what the run rate is for second half, a normalized China. And I think margins, overall in terms of the unit growth, better than feared. And that's why you're seeing, given Armageddon type expectations, you're seeing this rally. And I think now it also comes down to just execution. And I think that's really the key here that ultimately sends the stock higher.
It's not just about the deliveries, right? Because the deliveries are doing very well. It's also about margins. And it's my understanding that people are really focusing on that. And as the margins were getting squeezed, the naysayers were critical of that, but the margins on a Tesla are still much better than those of, say, Ford or GM, right? Tesla's still doing very well in that category.
This is a very important point from Nicole. Despite the fact that Tesla's automotive margins were down, what a disaster for the quarter. Of course, we know the factory shutdowns plus 2 new factories ramping explains why the margins were down. But despite the fact that Tesla's margins were, quote, disappointing in Q2, with explainable reasons, temporary reasons, there's still industry-leading margins in the automotive industry, despite being massively down. And when I say industry-leading, I'm not just talking a couple of % above competitors. I'm talking 2 or 3 times higher. But remember, you should definitely compare Tesla's valuation to other automotive companies based on how many units of vehicles they sold in the most recent year. And if Tesla's valuation seems high based on that metric, obviously you shouldn't own the stock. That's all the thinking you need to do.
Well, I think they have almost golden margins. When you look at gross margins, and me and you have talked about this, it's more of a, what I'll use almost a disruptive software technology play rather than just a traditional automotive company. I think if you look at margins, worst case fears are 25%. They came in auto gross margin of 26.2. You'll see some near-term pressure, just given what we see in terms of the Berlin build out, Austin, as well as some of the China issues. But I think, look, that rebounds into 2023. And right now they're on a run rate. They should be about 2 million going into 2023. And that's the key. Now, look, if you're a bear, it continues to just be about execution, always worried about another shortfall. But look, if you were negative on the stock at 200, split adjusted, you're going to, continue to be negative, even though it's had, thousands of a percentage point higher, because of what we've seen in terms of execution.
Do you still have a $1,000 target, and do you have a bull case?
Well, $1,000 our price target, and I just continue to view that. When could they get to $20 of earnings power?
Fair warning, I'm about to spoil things. If you haven't already seen the future via your crystal ball and or time machine, in 2023, Tesla will do at least $20 in earnings per share. Well, at least according to my base case for Tesla in my Tesla valuation model, which produces my Tesla price targets. That's the base case. As for my bull case, well, all I'll say is it is substantially above that amount. Given the fact that Dan Ives is known as the Tesla bull, and he's talking about the potential for the company to hit $20 in EPS at some point in the future, whereas this guy's got Tesla doing it done deal next year. I've got a funny feeling in the coming months and quarters, we're going to see Dan Ives or Wedbush continually bump up his Tesla price target substantially.
And then ultimately it starts to scale, because when you look ultimately at Berlin and Austin, that comes on board. It's also about production, because that's what we're seeing across the board. Look at Ford, look at GM. It's all trying to get the engines roaring going in 2023. Tesla continues to sort of have that prowess, not just from a demand perspective, but production. And I think it's all about the margin story, and it's all about the demand story. Recession, they're not immune. But I think if you look what we saw last night, investors feel a lot better going to bed, with these type of results.
Yeah, and you said the healthy guidance for the second half by Musk and the team that looks achievable with no margin for error. So we'll have a lot to talk about in the next 6 months, I'm sure, on this one.
I don't think there's a margin concern, to be honest with you. I mean, you look at the margins, they're fantastic relative to other automakers, but you also have to think about the secular component of their business. It's all about electric mobility, but also solar energy storage. So all these other elements which are growing on top of the automotive sales division. Again, quarter over quarter, they're down because of shutdowns. But the only thing really going wrong with it, and I can see why there's a case for short sellers to be on top of it and think, it should be at least maybe half of the current value, is really looking at the forward and trailing multiples. On a trailing basis, 80 times earnings. In this environment, I suggest it's probably a little bit lofty, but on a forward basis, it's 62 times. But margins are actually pretty impeccable. Operating margins, free cash flow margins, top line sales, again, for the quarter, 41%. But again, you have to consider that automotive revenues are still the largest component of their business. Forward estimates were 54%, and the company now is giving some relatively conservative guidance at 50% sales. So, it is what it is. Take it for what it's worth. But if you look again at forward revenue on the company's guidance at 50%, the estimates for analysts have about 70% EBITDA growth. So, we talk about this all the time. When your EBITDA growth is estimated to be higher than your revenue growth, your stock should be moving from bottom left to top right.
So basically, what he's suggesting here is that if your profits are growing at a faster rate than your revenue, shout out to operating leverage, which is exactly what's happening with Tesla, your stock should, in theory, be going directly to the moon and then onto Mars. At this point in time, I personally believe practically everyone, Wall Street stock analysts, retail investors, and the clowns in the mainstream finance media whose opinions are worth less than nothing, generally speaking, all are massively underestimating how quickly Tesla will grow its earnings. The more Tesla scales, the more profitable they become, and they're already at industry-leading margins at their current scale. Call it 1.5 million vehicles per year. In short, you ain't seen nothing yet, and very few investors out there are anticipating how quickly and enormously Tesla's profits will continue to scale as the company grows its production.
But valuation, again, might be one of the reasons that it's not moving based upon some of the other fundamentals I've discussed.
This is just anecdotally, because I'm a lay person. I'm not an auto analyst like yourself here. But I go around town and I see, it used to be just I saw Teslas everywhere. I've now seen a handful of Rivians on the road near where I live. I've just saw my first in-person real life Lucid Air driving around town. I've seen Hyundai Ioniqs around. How much is that competitive environment going to be a real headwind for Tesla in the coming months?
This is pretty hilarious. Now, in fairness, he said it's anecdotal, but the hilarity of this comment, I used to see Teslas everywhere, meaning I still see Teslas everywhere, but now I've seen at least 1.25, maybe 3 or 4 other electric vehicles in total produced by somebody other than Tesla. Does that mean the competition's finally coming?
Well, it
It is a hilarious response. I think what's happening here is, unlike this guy who just says what he thinks and doesn't mind being obnoxious, I think the analyst is trying to think of a nice way of saying, well, no, seeing a couple of vehicles from some other companies doesn't mean shit.
Well, of course, as consumers, we have more choice, and it's important. If Tesla doesn't lose share in its EV market, then there's no market. So I think we need to be aware that, of course, Tesla has to lose share if the market grows.
One, This is a great point, although obvious, it's just math. 2, could somebody please let Gordon the Class Clown Johnson know?
We need to keep in mind also, so as consumers, we have more choice. What still makes Tesla unique is the amount, how much they redefine the industry, how they sell their cars, how they develop their cars. A theme in the earnings call yesterday was simplicity. Everything in the auto industry is complex. Everything Tesla does is simple and therefore efficient. And those are the edges that we need to focus on, not the fact that, yes, there's competition. Of course, there's competition and it's welcome. Otherwise, there wouldn't be a market.
First of all, your price target on the stock is what, $733? That's essentially not far from where we're at right now.
I'm sure many of you saw this one coming. We're looking at the tipranks.com profile of Jeff Osborne of Cowen with the $733 per share price target on Tesla stock. I'm super big on credibility around these parts, and well, let's see here. Initiated coverage on Tesla in September 2016 with a sell. Continued to suggest investors sell throughout 2017 and 2018 and 2019 and 2020. And then after Tesla stock starts heading toward the moon, inexplicably changes the tune to a hold. Hold. Now, if you'd been following the advice of Jeff here, you would never have purchased Tesla stock. There is zero buy ratings in the last, call it 5 or so years. 0. Is this someone who has any credibility at all when it comes to Tesla stock? And I would argue, no. Success rate on the stock, 22%. Average profit on stock, loss of 128.8%. Now, this isn't to say that Jeff may not have some valid points about Tesla, but this is to say that when Jeff has anything at all to say about Tesla stock, it's really not worth listening. At the same time that I personally believe Tesla stock is the best risk-adjusted opportunity by miles that I'm personally aware of in the stock market, Jeff Osborne here is recommending don't buy the stock. No. At best, just hold on. This will not age well, and speaking of credibility, I encourage you, set a reminder for 12, 24, 36 months time for me to revisit this video and this prediction and me taking a dump on Jeff and having no idea what he's talking about, at least when it comes to Tesla's stock.
What did you see in the earnings report that tells you we could go sideways from here on the stock?
Quality beat, as Praz mentioned. We were looking for an over $400 million charge this quarter from the Bitcoin collapse. Unfortunately, that didn't play out, and it was about a quarter of that, given they sold 3/4 of their stake. They also had a pretty dramatic decline in R&D expenses. But really, the next few quarters are really about ramping up 2 new factories. They haven't done that since Shanghai ramped up. That'll be the laser focus moment for investors, as well as there's a bunch of new competitive threats coming out.
So, according to Jeff, who, as we've just seen, is incredible, and I mean the literal sense of incredible, not the colloquial sense, just not credible, Tesla has some actual legitimate competitive threats coming. And I think this actually is a valid point. Tesla will be producing them themselves, cannibalizing their own products. That's about the only legitimate threats to Tesla that Tesla has, is their new products.
You see Ford in the news today, doubling down on their EV strategy, but also GM this week with the Blazer, and you've got the Silverado on deck as well. So quite a bit of new material out there in the EV landscape.
Hey, Jeffrey, what do you think about, you mentioned the ramp-ups in Berlin and also Giga Austin. What's your take on the fact that Tesla updated their kind of install capacity forecast, right, from around 1 million to almost 2 million? You think that's doable? You think it's a note of like kind of like full steam ahead as they push forward through 2022?
Well, they're always super bullish, as you know, but I think it's going to take a while to get to that full utilization. They gave some breadcrumbs as it relates to weekly production, both in Germany as well as in Texas. That'll take some time, but I think by the fourth quarter of next year, you could start hitting that on a run rate basis, but certainly you would need an additional factory on the cards to be announced in the next 6 months or so to start hitting the targets for 24 and 25.
Now, I think what I heard there, according to Jeff, Tesla will not produce 2 million vehicles next year. In fact, they will just reach a run rate of 2 million vehicles per year by the end of 2023, meaning they'll have a shot at 2 million in 24. This is possible. God might also exist. But I personally believe that Tesla's going to do well in excess of 2 million vehicles in 2023. Delivered. Not run rate at the end of the year. Delivered in 2023. And unfortunately, well, at least for the Wall Street stock analysts, this seems to be a common opinion. No one seems to be taking Tesla at their word or actually using a calculator and going, hang on a minute, how quickly did Shanghai ramp up? Okay, slow that down a little bit for the 4680 cells. So we've got Austin and Berlin and Fremont. Let's do the numbers here. Where's the calculator? Okay, yeah, no one's doing that. They're just like, oh, that's too fast. They can't grow that fast, man. They just can't.
As you look at future growth for the company, especially if the Cybertruck comes out next year.
Hey, Jeffrey, do you think that this 2022 production forecast, that 50% CAGR of about 1.4 to 1.5 million vehicles delivered this year, is that doable, you think?
I think it's a stretch. We're just shy of 1.4 on our end. So I was a bit surprised that they reiterated the 50% target. I thought they would come in, more like 40, 45.
Fancy that. An analyst who, for the last half decade, has massively underestimated Tesla, being surprised that Tesla's own goals, progress, and their restatement of their target is significantly above what he personally believes they can achieve. I wonder how this one plays out. Is Jeff going to be right for the first time ever?
They're pretty loosey-goosey with the targets in terms of general ranges. Typically defined over multiple years. But yeah, that was a bit of a surprise. I thought they would use China as a scapegoat and lower the guide for the year.
Jeffrey, you talked about the gigafactories already, but just what about the product line itself? You know that there are upside and downside scenarios depending on whether or not Model Y or Model 3 end up cannibalizing sales of each other. Can you kind of detail a little bit more your thinking on that?
Yeah, I mean, look, they've raised the prices of both vehicles pretty substantially, well over 25% over the last 6 to 9 months. And so, first of all, at a macro level, we're concerned that they're sort of pricing themselves out of the sweet spot of demand, that $45,000 to $60,000 range.
Jeff, this is going to be awkward, my friend. Now, in fairness, I understand where he's coming from here. Surely, Tesla can't continue to sell more and more vehicles as they scale their production from 1.5 million to 3 million to 6 million to 12 million to 20 million vehicles per year at the current prices. But surely Jeff is aware of Tesla's current wait times. And surely Jeff is also aware of the fact that the reason Tesla is raising prices is A, to keep demand and wait times in check, because people are already waiting 3, 6, 9, 12 plus months to take delivery of vehicles, which is already unreasonable, and temporarily raising prices to get ahead of temporary cost increases, materials, parts, components, etc. So surely Jeff is aware that Tesla isn't raising prices because they can't afford to make vehicles any cheaper. It's because they can't afford to have customers waiting any longer, and that they're doing so from a position of strength. So surely Jeff is aware that when Tesla chooses to, they can lower their prices dramatically, right? So I'm not sure exactly what the point was here. Tesla's temporarily raising prices, yet they still have obscene wait times. This isn't permanent. They don't need their vehicles to be at this price forever. They're just doing it to keep demand in check, and also temporary price increases, material costs, they're passing them on so they can maintain margins. If Jeff were, say, talking about Rivian or Lucid or any of the EV startups, or in fact any of the legacy automotive manufacturers selling their EVs at catastrophic losses, he might have a point. Probably a problem if the price is already here and they're not making any money on them. That's a problem. But you see, Tesla's prices are temporarily here and they're making obscene money on them. They've raised prices from a position of strength. So I'm not sure what the point was there.
Certainly they're well at the higher end of that. And so I think they do need to drive that down. But unfortunately, the inflation on the batteries is leading to pretty much everybody in the EV landscape having to raise prices. But in terms of the Y cannibalizing the 3, that's been playing out for a while. We do have some concerns that a lot of the China production, typically anywhere from 25 to 40% on a monthly basis, is exported. And as you start having localized production in Europe, of the Y in particular, I think there'll be less of an appetite to export from China. And so really you'll need to see the Chinese embrace the vehicle in earnest. And so the comment about the fiat currency that you had before I came on, my sense is quite a bit of that is in Chinese currency, but we'll have to see when the 10Q comes out.
Hey, Jeffrey, I wanted to talk to you a bit more about macro stuff here. Initially in the call, Tesla is sort of talking about a little bit of demand weakness. They started noting some demand issues. And then when analysts followed up on it several times, they said, no, we have no actual data on that. Demand is fine. It's always been a production supply problem. What was your take on that?
Well, I think Elon sort of answered your question when he said he only hops on the call when there's negative news. So he needed to manage the message. If it was a great quarter and there was nothing to manage, I don't think he would have been on the call. But look, I do think there's some very small cracks in demand. Certainly the lead times for all electric vehicles right now, Rivian, Ford, et cetera, are multiple months, if not multiple quarters.
This is a true statement. However, a little bit of context is necessary so we really understand what's happening here. Tesla is producing many hundreds of thousands of vehicles per quarter, and yet still have crazy wait times. Rivian and Lucid are producing less vehicles per quarter combined than your girlfriend has banged dudes in the last 2 years.
But you can place orders and look at place a fake order, if you will, and see when you would get a delivery. And Tesla is still an elongated demand cycle. It's not like there's a bunch of vehicles sitting on the lot. So look, I think demand is very strong. I'm not sure it's running at a 2 million run rate that they're talking about, especially with the portfolio being a bit stale in my view.
Well, I'd be delighted to take the other side of that bet, Jeff. So, here's something I'm happy to put on the record. In 2023, Tesla's Model 3 and Model Y sales combined will exceed 2 million vehicles. And by the middle of this decade, they'll exceed 3 or 4 million vehicles, just based on those two products alone. Again, keeping in mind, Tesla has massive pricing power. The more vehicles they produce, economies of scale, costs come down, and so on. We're not talking about at today's prices. Over the longer term, Model 3 and Model Y combined sales could easily be 3, 4, maybe even 5 million vehicles per year. I don't think Jeff sees this. I don't think most Wall Street stock analysts see this. In fact, I don't think most people understand this very simple concept. You only need one category killer per category to absolutely dominate. There's very few categories left for Tesla. We've got a compact car and a pickup truck and all else. Yeah, maybe a van, but that's going to be fairly low volume. This is it. Cybertruck drops, then Tesla announces a more affordable vehicle when they need to, which could be a while. As we know, Tesla's already delayed the $25,000 vehicle because there's no need. Demand's already insane for their $45,000 3 and Y. This seems to be one of those intellectual sticking points. People just think, how is it possible that one or two models could sell more than the world's best-selling vehicles each today? It's not possible. Can't be that good. Therefore, they need more models, otherwise they can't keep selling all their vehicles. Why is it that Apple doesn't have 27,000 different variations of every single product they produce? Oh, that's right, because you don't need them.
So they need something new to get investors excited, at least institutional investors that I talk to.
That last comment puts a lot of things into perspective. Jeff is, of course, living in Wall Street land where institutional investors are so smart, managing their tens upon tens, sometimes hundreds of billions of dollars of capital, that they all need Tesla to have 69,000 different product offerings in the pipeline and in the marketplace for them to feel confident that they can continue growing at a ridiculous rate. And of course, since Tesla's opting to have a single category killer per category, and the institutional investors believe that the only way to sell more vehicles is to have 69 trillion different variations, this may explain why lots of Wall Street analysts and big institutional investors aren't really super fond of Tesla stock and haven't been for the last, 1,500%. I always find it fascinating to listen to what the talking heads in the finance media and the Wall Street stock analysts have to say about Tesla the company, Tesla stock, and the electric vehicle transition. Definitely a mixed bag here, which is unsurprising. Tesla has to be one of the most controversial companies and Tesla stock one of the most controversial stocks in the entire marketplace. Why? The great variation of opinions. There's many investors out there who believe Tesla is well and truly on track to become the world's largest company by revenue, by profits, and by market cap in just a few years' time. There's also many extremely academically intelligent people and Wall Street stock analysts out there who genuinely believe that there's actual legitimate competition finally about to come for Tesla instead of all over itself. I genuinely have absolutely no idea how long it's going to take until the general overall consensus opinion on Tesla actually aligns fairly closely with reality. Maybe it never will. But until then, the massive disconnect is presenting incredible buying opportunities, in my opinion. Still loading up with every spare cent. Still baffled and stunned at some of the incredibly idiotic things being said on Wall Street and in the finance media relating to Tesla. And still low-key hoping that this massive disconnect continues for as long as possible so I can continue getting closer to my long-term goal of owning 0.001% of Tesla. So if you enjoyed the video, don't forget to smash your girlfriend and unsubscribe. Wait, did I? Yeah, I think that's right. Oh, and lastly, don't forget to join Patreon with the card in the corner or the link in the pinned comment to gain access to my Tesla stock price targets, loads of exclusive content and perks, and plenty of thoughts and opinions I'm not able to share here on YouTube. So I'll see you over on Patreon. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.